I lost my life savings in one stock. Yep, that's exactly what happened to this person, something which I read on Reddit. This person lost $100,000 when he invested his life savings into Bed Bath & Beyond, ticker symbol BBBY, and this stock, as you know, has collapsed over the last couple of years, in fact, but eventually it went bankrupt. It declared bankruptcy and he lost his life savings. And he said, it's mentally draining. You know, it's like all these years of hard work gone because of one stock. And every time I read things like that, I really shake my head. Not because it's devastating to these people, but it is so preventable. It is so avoidable. And sadly, this is not the first time that this has happened. This has happened many, many times to many, many people, and it will continue to happen to a lot of people down the road, sadly. And every time you find a stock collapses, you read somewhere, somehow, someone put their life savings in there and their life is ruined. And this could happen to any stock in any industry in any country. Like back in 2000, 2001, you had stocks like Enron, WorldCom collapsing and people lost their life savings. And then in 2020, you've got like a Chinese company called Luckin Coffee that collapsed. Again, people lost their life savings. And then more recently, we had Silicon Valley Bank that collapsed, Signature Bank that collapsed, and now First Republic Bank is on the verge of collapsing as well. And no doubt there'll be people again who lose their life savings. And again, it's not just stocks, people who lost their life savings in Luna or FTX, and the list goes on. So when you read about things like this, it's not just about feeling bad for that person or being scared yourself about investing, but the most important question to ask is, what can I learn from this? Since I was young, I learned a really important concept that yes, it's important to learn from my mistakes. But what's even more important in life is to learn from other people's mistakes. That's how you cut short your learning curve massively. So what can you learn from this? When you read stuff like that, does it mean that investing is risky? Does it mean that this person just had bad luck? And the answer is no. Remember that it is not what happens to us in life that determines our success or failure, but it's the meaning we give to what happens to us and what we choose to do about it that determines our eventual success or failure. So again, let's look at something like this. If this happened to you or this happened to someone you know, what's the meaning of this? What's the lesson that we need to learn? So does this mean that investing is really risky, that we too could one day lose our life savings as an investor? The answer is no. So remember that investing, stock investing itself is not risky, but it is the way people invest, or should I say gamble and speculate, that makes it risky. If you invest following the right investment rules, which I follow, which I teach my students, for example, we only invest in high quality businesses. We only invest when prices are undervalued. We always build a portfolio, a diversified portfolio of several great companies. If you follow those rules, investing is extremely safe. For example, I've got over $11 million right now invested in the stock market. And people ask me, Adam, how can you sleep at night with all this bad news of a recession coming, of high interest rates and banks are collapsing? How do you sleep with $11 million in the stock market? And I'm here to tell you that I can sleep really well at night because in my mind, to me, there's almost no risk in the way I invest because I follow these investment rules. And I like to emphasize these rules for you in this video because if you follow these investment rules, you can have millions invested in the stock market and you feel completely assured and completely safe. But the trouble with most people is that they don't follow these investment rules. They break all the rules. And when you break all the rules, it can be extremely risky. So let me give you an example. Is driving very risky? Well, it depends. If you drive following all the traffic rules, green light you go, red light you stop, drive under the speed limit, wear your seatbelt, have your airbags, check your blind spot, then driving is relatively safe. Driving gets you where you want to go a lot faster. It's more convenient. But if you were to drive blindfolded, drunk, high, and you're driving with your feet on the steering wheel, then of course driving is risky. But this is exactly how many people go into the stock market. They're kind of like driving with their feet on the dashboard, blindfolded and high. And of course it's risky. Of course you can get into a crash and you can lose your life. So what can we learn from this poor guy's experience? What mistakes did he make that caused him to lose his life savings? Remember, it's not the stock market that caused him to lose his life savings. It's not bad luck that caused him to lose his life savings. It is he himself that caused him to lose his life savings by making these mistakes. So once again, what are these mistakes that this person made? So mistake number one, which is a very common mistake that people make, is investing in low quality businesses. Now, always remember that when you buy a stock, you are buying a piece of a business. You're not buying a lottery ticket. You're not buying an alphabet that goes up and down and you're kind of like predicting where it's going to go. No, you're buying a piece of a business. So a lot of people make the common mistake of buying low quality businesses because it looks cheap. Now, remember that cheap crap is still crap. One of the things that I keep reminding my students of is that don't buy a stock just because it looks cheap. The most important thing is that it has to be a high quality business. Being a high quality business is the first priority. So it's in fact better to buy a high quality business that is fairly priced than a low quality business that is cheap. So what's a high quality business? What does that mean? Now remember that a business is a money making machine. It's as simple as that. The more money the business can make, the more it is worth. So a high quality business is a business that consistently increases its sales revenue. It gets more and more customers, more and more market share year after year after year, and over time the net profit increases, the free cash flow increases. A high quality business is one that's financially very strong. They've got a lot more assets than liabilities. They can weather any kind of recession, any kind of short-term interest rate increase. So take a look at Bed Bath & Beyond. Now again, why would people even buy this stock? Because to them, the layman, it looks very cheap. Why? Because if you look at the chart, for example, I mean, this was at $42. And they think, hey, it was at $42 and now it's at $20. It's half price, so 20 is cheap, right? That's what they think. And from 20 it goes to $10. Wow, is even cheaper now. Then you buy at 10, from 10 it goes to $5. Wow, $5 is so cheap. Then it goes to $2.50, half price again. And from $2.50 it goes to $1.25, $1.25 goes to 60 cents, and now it's down to freaking 10 cents. You think 10 cents is cheap? You buy it 10 cents, it goes to zero. Okay, so again, cheap crap is still crap. Don't buy something just because you think it looks cheap. Now again, if you had actually looked at the financials of the business, you would never have touched Bed Bath & Beyond. So obviously, this guy who bought it, he didn't look at the financial statements. He didn't look at the balance sheet. A company doesn't go bad overnight. It takes years for the company's business to deteriorate. So it's like you can see the train coming from a mile away. And if you're still standing there and the train runs you over, it's really your fault. So again, take a look at Bed Bath & Beyond, BBBY. Now I'm at Guru Focus, which is one of my favorite websites, where I can visually see, again, the financials of the company. Now just take a look at this visually. Has the company been losing business overnight? No, it's been happening for the last 5 years. Check it out. Look at the sales revenue. The sales revenue has been falling year after year after year after year after year. For 1, 2, 3, 4 years, the revenue's falling. I mean, it's so clear that it's a dying business. Look at the profits. The profits have been declining for 1, 2, 3, 4, 5, for 7 years, the profits have been declining, right? The profits going down, going down, going down, losing money, losing money, losing money, losing money. I mean, why on earth will you buy such a company? You're buying a dying business. And same thing, look at the free cash flow. Look at the operating cash flow. It's falling every single year and is going negative. And if you look at a balance sheet, for example, it's got a very weak balance sheet. I mean, straight up, the current ratio is 0.73. What does that mean? That means the company has more current liabilities than current assets. If the company owes more than what it has, then it's a very risky business. Look at the debt to EBITDA ratio, the debt to equity ratio. It fails all these ratios of a financially strong business. Another example is Credit Suisse. Credit Suisse went from $14 to now 80 cents. And again, there were people who asked me a couple of months ago, hey Adam, should I invest in Credit Suisse? I say, why on earth? They say, because the stock looks really cheap. And what do I say? Cheap crap is still crap. So in the first place, Credit Suisse is a low quality business. It's a dying business. And again, it didn't die overnight. It's been dying for many, many years. How do you know? Look at the financial statements. It is so clear. And you wonder, why would people in their right mind ever touch a stock like Credit Suisse? It doesn't make sense. Now look at that. Look at their revenue. Their revenue has been in decline on this downtrend since 2013. For 10 years it's been going down, right? Look at their profits. It has been, losing money, making money, losing money, a very inconsistent, low quality business. So again, you have to avoid these businesses. So if you avoid low quality businesses, it's really hard to lose money. But some people think that, but Adam, if I invest in high quality businesses, they are usually very expensive. No, they are not. Not all of them. So you have to do your research. You have to dig for gems, for unpolished gems. So one of the things that I do for my subscribers is that in my Ultimate Investors Playbook, every month I will find and do an in-depth research to find the best companies, the highest quality stocks that are undervalued. And that's where we find opportunities to make a lot of money. So let me give you one example right now. Winnebago. Have you heard of Winnebago? Winnebago is one of the leading designers and manufacturers of motorhomes and recreational vehicles in the US. Now, if you look at this business, Winnebago, is it a high quality business? Absolutely. It's a great business. Why? Well, let's take a look. Again, we're going to Guru Focus and check out their long-term financial results. Look at their revenue. Their revenues are increasing consistently year after year after year. So even in the recession in 2020, in the pandemic, they are still able to grow their revenue. So we call this a consistent, predictable, high quality business. Revenues are growing consistently. Remember again, a business is a money-making machine. The more money it makes, the more it is worth. So this business is worth more and more every single year. Its intrinsic value keeps rising as revenues are growing, and its net profit in green has also been growing consistently. Now, if you zoom into that, you can take a look over here. In green, their net income, net profit growing consistently year after year. A free cash flow in blue growing consistently year after year. Another very important indication of a high quality business is when the company has high return on equity and high return on capital. So for Winnebago, for example, you can see that the return on equity is 24%. That's really high. Now, generally, a company with an ROE above 12%, that's a good business. Above 15% is an excellent business. Now, this stock has 24% ROE. Next, return on invested capital. Again, same thing. Above 12%, good. Above 15%, excellent. Their ROIC is 19%. So extremely high quality business, extremely profitable business. You can see that their gross profit margins rising year after year over time. Their operating margins rising as well. Net profit margins rising as well. Now, finally, we look at the financial strength. Does it have a strong balance sheet? So you can see the debt to equity ratio is less than 1, is 0.47. So they've got more equity than debt, which means it has very low debt relative to its equity. They've got a debt to EBITDA ratio of 1.28, which means that they can pay off all their debt with 1.28 years of profits. Their interest coverage ratio is 14 times. They're covering their interest 14 times over with their profits, and their current ratio is 2.5. They've got 2.5 times more current assets than current liabilities. So it's an extremely safe, high quality business. When you invest in stocks like these that are high quality businesses, it's literally almost impossible for the stock to go bust or for it to go bankrupt. Now, but the question is, okay, it's high quality company, but is it cheap, right? So remember, we want to buy high quality companies only if they are cheap. So let's look at some valuation metrics. Now, if you look at their PE ratio, price to earnings ratio, you can see it's 6 times earnings. So is 6 times earnings cheap or expensive? Well, if you take a look at the history of the stock, over the last 18 years, you can see the highest PE ratio was 44 times. The lowest PE ratio for the stock was 4 times earnings. Right now it's selling at 6 times earnings, which is below the long-term average of 14.48 times earnings. So based on the PE ratio, it looks very, very undervalued. But again, PE itself can be very misleading. PE is a very rough way to measure stock. So I like to use a discounted cash flow model. And based on my discounted cash flow analysis, assuming a very, very conservative 5% growth rate for the business moving forward, which is really conservative because historically, you can see that they have been growing at 38% a year for the last 5 years. So I'm going to assume we're going to have a recession, although we may not, but when I value a stock, I always like to assume the worst. So let's assume there's going to be a recession, their growth is going to go from 38% to only 5%, right? So I'm being really conservative here. And even based on a 5% growth rate, that gives me an intrinsic value of $123. So in other words, I know the business is worth $123 per share, but the current share price is only $58. So it's now selling at a 52% discount. Now, I'm not recommending you buy this stock. I'm just showing you an example that there are high quality companies that are very cheap as well. And if you want to invest, you only want to invest in high quality companies first. That's the first priority. And then number 2, only buying them when they are undervalued. Now, Winnebago is just one of many, many examples. I can tell you that right now in the market, yes, there are some stocks that are really expensive right now, but there are also many stocks that are very high quality that are still very, very cheap. So you got to learn how to find these stocks. And when you invest in these high quality, cheap companies, you can make a lot of money over time. If you want to learn how I identify and how I analyze stocks from all around the world and how I find the top 1% of companies that are undervalued, yeah, you can learn it from my value momentum investing course that you can enroll for at piranhaprofits.com. And for people who are too lazy to do their own research, they say, Adam, I need to find the stocks for me, tell me when you're buying, tell me when you're selling, then of course you can subscribe to my Ultimate Investors Playbook, where you get to watch how I invest and trade live every single day, where I do a in-depth monthly review of my portfolio, of my performance, so that you can see how I invest. And that's how you learn as an apprentice. So you can check out this UIP subscription at insight.piranhaprofits.com. Now, remember that just because you buy a stock of a high quality business that is undervalued, it doesn't mean the price must go up right away. It doesn't mean that the price goes up in a straight line. Because in a short term, prices are driven by speculation, manipulation, emotions, and news. And prices always move in wave patterns. Like if you look at Winnebago, yeah, over time, the price will go up. All right, I mean, it's not 100%, but it's a pretty high probability as it makes more and more money. But in the short term, it goes through these wave patterns where you have got this, wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down, wave up, right? It goes through ups and downs. So you want to accumulate shares when it goes through these wave down patterns so you can accumulate at undervalued levels. And again, these are things that we cover in our courses, and I show you real time how I accumulate shares in my UIP, for example. The second lesson to learn from this poor guy to ensure you never lose your life savings on an investment is to always diversify. Remember, never put all your eggs in one basket. No matter how great you think a stock is, never put all your life savings in one stock. That's freaking insane. You have to diversify into a portfolio of at least minimum 8 to 10 great companies. So it doesn't matter how much you invest, whether you're investing, $500 or $1,000 or 10,000 or 10 million, the same rule applies. You have to diversify into at least 8 to 10 great companies. Why? Because no matter how great a company is, shit can happen that sometimes you just can't foresee. For example, Boeing for many, many years was a great business. It's an oligopoly with Airbus. They manufacture airplanes, and for years and years, their revenues went up, their profits went up. It's a great business. But what happened in 2020? Something happened that no one could foresee. There were 2 plane crashes, their 787 models were grounded, and then we had COVID-19 pandemic, airlines were grounded, they cancelled their orders, and Boeing, for the first time in history, their sales and profits dropped, 70-80%, and the share price dropped 80%. So can you imagine if you put your life savings into Boeing stock and your entire life savings drop 80%? You will freak out, right? You get a freaking heart attack. Now, did I own Boeing stock before the pandemic? Yes, I did. I didn't predict the pandemic, so I invested in Boeing because I thought it's a great company, which it was. But because I diversified, Boeing was only one small part of my entire portfolio. So even though my Boeing shares went down 80%, I was like, it's okay because my other stocks went up, which buffered the short-term drop in Boeing. And because I diversified, even though 1 or 2 stocks collapsed, I still ended the year of 2020 in that recession up 44% in one portfolio, 41% in the other portfolio, and still made over $700,000 in profits. So diversification is really, really important. And if I could use an analogy, people who put all their money into one stock, it's kind of like being in an airplane with only one engine. Now, they may think, hey, it's a great engine, it's a Rolls-Royce engine. Now, again, no matter how great an engine is, it could get struck by a bird. Have you heard of bird strikes, right? You get that one engine struck by a bird, and that engine fails, you're going to crash. But imagine if your plane had 8 Rolls-Royce engines. Now, one engine can fail because it gets hit by a bird, 2 can get hit by a bird, but what's the chance that all 8 get hit by birds? What's the chance that all 8 engines fail? It's almost 0 chance that's going to happen. So again, if you have got at least 8 to 10 great companies and the plane is kind of like your portfolio, you will always ensure your plane will never crash and it can land safely. I remember the first interview I watched on Warren Buffett. He said the number 1 rule in investing is to never lose money. And I thought to myself, how can you never lose money? Is it something that you can really control? And what Buffett meant was this, that if you buy a group of great companies collectively and you buy them for less than what they are worth, it is impossible to lose money. It is literally impossible to lose money. And that's why for me, because I've got a diversified portfolio of the top 1% of companies in the world, to me, it is impossible to lose money because collectively, they will always increase in value over time. Sure, the share price could go up and down through volatility in the short term, but over time, they will always go higher. And that's how I can invest with complete peace of mind. The last piece of advice I can share with you is that when you have a portfolio of 8 to 10 or 20 companies, you have to ensure that they are in different sectors. Like, don't just have technology stocks. Like, if you only have technology stocks, last year when tech stocks collapsed, your whole portfolio would drop significantly. Or if you only had all bank stocks and during the bank crisis this year, all your stocks would go down at the same time. So you always want to diversify into technology companies, some healthcare, some financials, consumer staples, consumer discretionary. So you've got a balanced portfolio. So in my portfolio, I balance among the best sectors in the market as well as into different types of stocks. Some growth companies, some defensive companies, some more dividend paying companies. And that's how I consistently grow my investment portfolio over time. So I do hope that you have learned some important lessons in this short video. Again, if you just follow these important rules. Number one, only buy high quality companies. Number two, diversify into at least 8 or 10 companies. Then investing is very, very, very safe. And investing gets you to where you want to go, which is financial freedom from the rat race. So take care, and I'll see you guys in the next video coming up soon. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.